Hello guys, and welcome back to my channel. In today's video, we'll be going through why you should invest during a market crash and how to do it. What to do and what not to do. A lot of people are saying that you shouldn't invest during a financial crisis, and yes, it might be risky, but it might also be the best time to invest your money. And even though it seems like a bad idea, it is actually a great time to start out investing as well. This being said, investing during a market crash is a risky affair. But if you do it the right way, you will be able to come out on top after a recession. You simply have to use the method called dollar cost averaging, which is also called DCA. It is a way of spreading out your investment in a certain period of time. It will lower your risk and give you some pretty great advantages in the long run, and is especially an effective way of trading during a market crash. So what exactly is dollar cost averaging? DCA is a method where you choose a certain time frame, like for an example 2 months or 1 year, or it can even go on for many years, depending on where your invested money comes from. But let's say that you have $10,000 that you want to invest, but you think it's too risky to invest right now because you're worried that the stock market will drop 5% or more the day after your money is invested, which is a fair concern to have during a financial crash. And it would be very sad to lose 5% of your hard-earned money in just one day. And it could possibly take a long time before the economy is back on track again. This is why you should never invest all of your money at one point during a recession. Because, let's be honest, nobody actually knows when we have hit the bottom. But here you should instead use DCA. Okay, let's get back into you having $10,000. How should you invest if you shouldn't put all your money into the stock market at once? As I said, you should choose a certain time frame, and if it's possible for you to kind of see when the economy should be back on track again, then that time frame would be a good time frame to choose. Let's say that we expect the current coronavirus to last for about 10 to 12 months before stores, bars, schools, and our everyday life is back to normal. Then you could divide your $10,000 into 10 parts of $1,000 and pick a date in the month where you then invest that money into the stock market. Maybe also into an ETF that will spread your money out even more, so you don't lose a big chunk of your money just because a certain industry is hit pretty hard because of the coronavirus, or whatever causes the current financial crash that you're in. Another way of doing it, if the market is completely unstable, could be to invest $250 every week for the next 10 months. That will take some extra work, but could also benefit you if there is some big day-to-day changes in the market. In that way, you'll still invest $1,000 every month, but here you'll use the advantage of DCA even more. DCA is a way of lowering your risks, especially during an unstable market. But DCA is always a great option to invest your money, and it doesn't matter if you just want to buy a specific stock or if you want to get into the stock market through a wider ETF or mutual fund. If you want to make sure not to buy an overpriced stock, then DCA is a great option. You can risk only being a small part of a big upside if the stock you invested in rises a lot just after your first or second investment, but on the other hand, you could potentially also stay away of a huge drop if the opposite should happen. Here you'll follow the market when it goes up and when it goes down, which in the long run is actually beneficial. Let's take an example of how DCA works. Let's look at the math behind it. Alright, let's say that the stock DCA Example has a stock price of $10 per share on January 1st, and you have $10,000 that you want to invest in this company. We have two different examples. Example 1, let's call it predicting the future. You invest all $10,000 at once and hope that your stock will go up. And example 2, let's call it DCA. you invest $1,000 every month for the next 10 months. Alright, let's see what happens if we consider this to be during a financial crisis with some huge drops and gains from month to month. In example 1, you now just have 1,000 stocks where you paid $10 per share. And with DCA, you now have 100 stocks where you also paid $10 per share. After 1 month, the stock rises to $14 per share, and you again spend $1,000. This time, you can buy 71 stocks. The next month, let's say that the stock drops to $9, then you can buy 111 stocks. Then it rises to $13, so you can buy 76 stocks. Then it again drops to $9, then 8, then it rises to 8.5, drops to 7.5, then 9, and then after 10 months, it's back up to $10 per share. Then, what happened? In predicting the future, you still have 1,000 stocks where you paid $10 per share, which is the exact value of them right now. But in the second example, you'll now have 1,055 stocks, which is now valued at $10,550. But still, you have only spent $10,000 on them. So this shows you why it's a great idea to use DCA in an unstable market. As I said, my previous example was when the market went up, but then continued a downtrend, and just came back to the starting point. And some of you might be thinking that DCA probably won't be as beneficial if the market is in an uptrend. And yes, you're right, it is mainly beneficial when the market goes down, since you are able to buy more at a cheaper price. The good thing about DCA is that not even the best investors know when the market have hit the bottom, and therefore DCA is a good way of spreading out your investments in order to limit your risks. If you use DCA in an uptrend, then you won't gain as much money, but on the other hand, if you use it during a downtrend, then you won't lose as much money. So if you want to limit your risk and you don't have the ability to look into the future, DCA is a great method of investing. DCA is a way of averaging your entry price into the market or into a certain stock. It will limit your risk, but also possibly make you miss out of some profits if the market is in an uptrend. It is a great way to invest your money during a market crash or an unstable market in general. So if you want to get into the market and doesn't have a magic crystal ball, then DCA is a great way of entering the market with limited risks and still the potential of some nice profits in the long run. A way a lot of people use DCA is by setting up an account at their broker, where they'll transfer a specific amount to every month just after they get their paycheck. At some brokers, you can even set up an account that will automatically buy some specific ETFs or mutual funds for you. And therefore, you don't have to do any work, but gets the benefit of DCA, and at the same time, it is a great way of generating a nice savings account. So now, you should all go and place an automatically deposit into your broker every month. Even as low as $100 or lower every month could benefit you in the long run, which I also described in my previous video. So go check that out. I hope you guys learned something about dollar cost averaging. If you did and you enjoyed the video, please make sure to subscribe to my channel for more videos about investing.